Stocks finished strong this week. The Dow and S&P 500 had their best week since November 2023. The Dow went above 44,000 for the first time. The S&P 500 closed at a record high for the third straight day. It briefly went above 6,000 for the first time. This is a big deal. These milestones show that investors are optimistic. The economy is doing well. Interest rates are stable. Companies are reporting strong earnings. All of this is pushing stock prices higher. But how long can this bull market last? We'll explore historical patterns. We'll look at the factors driving the current market. We'll see if this bull market has more room to run. Buckle up, investors. Things are about to get interesting. Let's break down the performance of the major indices. The tech-heavy Nasdaq also hit a record high this week. It had its best week since September 13th. The small-cap Russell 2000 index had its best week since April 2020, gaining 8.4%. This tells us that investors are bullish on companies of all sizes. They see growth opportunities across sectors. The strong performance of the Russell 2000 is particularly noteworthy. Small-cap stocks are considered riskier. Their outperformance suggests a high level of confidence in the market. This broad market participation is a healthy sign. It suggests that the rally is not being driven by just a few large companies. Instead, it's a broad-based move higher. This is further evidence that investors are confident in the overall economy. Now, let's talk about the fear gauge, the CBOE Volatility Index, or VIX. It measures investors' expectations of future market volatility. A higher VIX indicates greater fear in the market. A lower VIX suggests complacency. Guess what? The VIX hit its lowest level since August 19th this week. This means that investors are incredibly calm. They're not worried about a market correction anytime soon. While this calmness is understandable given the market's performance, it's also a bit concerning. Markets don't go up in a straight line forever. Corrections are a natural part of the cycle. The low VIX suggests that investors may be becoming complacent. We need to be prepared for potential volatility ahead. Since the 2008 financial crisis, we've seen a fascinating pattern in bull markets. They typically follow a two-year cycle. We see a two-year rally followed by an 18-month downturn. This creates a stair-step pattern upward. Think of it like climbing a mountain. You go up for a while, then you take a break, then you go up some more. This pattern has been remarkably consistent over the past decade. It's been driven by a combination of factors. We've seen economic growth, monetary policy, and investor sentiment. But what if this time is different? What if we're entering a period of sustained growth without those 18-month pullbacks? It might sound crazy, but history suggests it's possible. Let's delve into the archives and see what we can find. Section 2. A different paradigm. From 1981 to 1987, the stock market experienced an incredible rally. The S&P 500 surged by 229%. Then came the crash of 1987. On Black Monday, the Dow Jones plummeted by 22.6%. After a brief panic, the market rebounded sharply. From 1987 to 2000, the S&P 500 soared by 582%. Section 3. Parallels to the past. Could we be on the verge of a similar extended bull market today? There are striking parallels between the current market environment and the period following the 1987 crash. Both came after periods of significant market turmoil. Both saw a surge in investor confidence. Both were supported by strong economic fundamentals. The 2020 market reset, triggered by the COVID-19 pandemic, was swift and severe. But it was also short-lived. The market recovered quickly, fueled by massive government stimulus and near-zero interest rates. This reset, like the 1987 crash, could be viewed as a launching pad for sustained growth. Of course, history doesn't repeat itself perfectly. There are differences between now and the late 1980s. Interest rates are rising, inflation is a concern, and geopolitical risks are elevated. But the similarities are undeniable, and they suggest that we shouldn't dismiss the possibility of another multi-year bull market run. Section 1. The calm before the storm. Remember that 2-year cycle I talked about? The one with 2 years of gains and then an 18-month pullback? Well, it looks like that pattern might be changing. Could we be headed for a much longer period of growth? From 2009 to 2020, the S&P 500 delivered a whopping 400% return. That's huge. And guess what? There weren't any major corrections during that time. It was a steady climb higher. Now, I know what you're thinking. Jim, that's impossible. Markets don't go up forever, and you're right, they don't. But they can go up for a really long time, especially after a major reset, just like we saw in 2009, and just like we might be seeing now. Section 2, 2020, a market reset. Think back to 2020. The COVID-19 pandemic hit and the market crashed. It was scary, but then something incredible happened. The market rebounded, and it rebounded fast. Why? Because of unprecedented government stimulus and rock-bottom interest rates. That crash and recovery acted like a reset button for the market. It cleared out a lot of the excesses and set the stage for a new bull market. And that's exactly what we might be seeing right now. Remember the 1987 crash? It was a bloodbath. But after that, the market took off like a rocket. Could 2020 be our 1987? Could this be the start of a multi-year bull market that defies all expectations? It's a real possibility. Section 3. A new era of growth. Now, I'm not saying that we're going to see another 582% gain like we did from 1987 to 2000. That would be insane. But what I am saying is that we shouldn't be surprised to see strong returns for several years to come. There are a few reasons to be optimistic. First, the economy is in good shape. Yes, there are challenges, but overall, things are looking up. Second, interest rates are still relatively low. That means that borrowing is cheap, which is good for businesses and consumers. And third, technology is driving innovation and productivity like never before. Of course, there are also risks to consider. Inflation is a concern, geopolitical tensions are high, and we could always see another unexpected shock to the system. But for now, the bulls are in control, and as long as the fundamentals remain strong, there's no reason why this bull market can't continue to run. Parallels and potential. The market reset of 2020, triggered by COVID-19, resembles the 1987 crash in its potential for growth. The 1987 crash, with a 40% decline, led to the longest bull market in history. Similarly, the 2020 reset was swift but short-lived. The market rebounded with government stimulus and low interest rates. This recovery shows the market's resilience. The parallels suggest the 2020 reset could lead to extended growth. Section 2. Back-to-back returns. The current market cycle has already begun to reflect the potential for sustained growth, with back-to-back years of double-digit returns already materializing. This achievement aligns with the prediction of an extended bull market phase and suggests a potential departure from the recent cyclical patterns of 2-year rallies followed by 18-month downturns. The occurrence of consecutive years with double-digit returns underscores the strength of the current market momentum. It suggests that the market is not merely experiencing a short-term bounce, but rather a sustained upward trend, driven by robust economic fundamentals and favorable investor sentiment. This early indication of consecutive double-digit return years provides further credence to the possibility of a prolonged bull market. It suggests that the market may have entered a new phase characterized by sustained growth and resilience, potentially defying the historical pattern of shorter cycle rallies and corrections. Section 3. A bullish outlook. The outlook for continued bullish momentum appears promising if market data remains above the crucial 42% bullish threshold. This indicator serves as a key benchmark for gauging market sentiment and potential upward movement. As long as the market data remains above this level, it suggests sustained buying pressure and upward price movement. Coupled with other technical indicators, it provides valuable insight into the market's potential trajectory. Section 1. Riding the bull. So, how do we know if this bull market has legs? One key indicator is market breadth. This measures the participation of stocks across the market. We want to see a broad-based rally, not just a few big names carrying the load. One way to measure market breadth is by looking at the advanced decline line. This tracks the number of stocks advancing versus declining each day. A rising advanced decline line is a bullish sign. It tells us that more stocks are participating in the rally. Another important indicator is the number of stocks making new highs. When we see a large number of stocks hitting new highs, it's a sign of strong market momentum. It tells us that investors are confident and willing to push prices higher. We also want to look at the performance of different sectors. Are all sectors participating in the rally, or is it just a few? A broad-based rally across sectors is a sign of a healthy market. For example, if we see technology stocks soaring while financials and industrials lag, it could be a warning sign. It might suggest that the rally is too narrow and vulnerable to a pullback. Another important factor to consider is market sentiment. Are investors too bullish? Are they ignoring potential risks? Excessive optimism can be a contrarian indicator. It might suggest that the market is due for a correction. Now, it's important to remember that no indicator is perfect. Markets are complex and there are always factors that we can't predict. That's why it's crucial to use a combination of indicators and to always be prepared for the unexpected. One way to stay ahead of the curve is to monitor technical indicators like moving averages and momentum oscillators. These indicators can help us identify potential trend changes and overbought or oversold conditions. We also need to pay attention to economic data, like GDP growth, inflation, and interest rates. These factors can have a significant impact on market performance. And let's not forget about those pesky geopolitical risks. They can throw a wrench into even the most well-thought-out investment strategy. The stock market is currently experiencing remarkable strength and resilience. Historical patterns and economic fundamentals suggest continued bullish momentum. Overcoming challenges like the COVID-19 pandemic highlights the market's adaptability. Exceptional returns over an extended timeframe are possible with evolving market dynamics. Embrace a long-term perspective, focus on quality investments, and maintain disciplined risk management. While the outlook for the market appears undeniably positive, it is crucial to remain vigilant and maintain a healthy dose of caution. Markets are inherently unpredictable, and unforeseen events can quickly shift market sentiment and disrupt even the most well-established trends. Therefore, it is essential to avoid complacency and continuously monitor key indicators for any signs of weakness or potential trend reversals. Technical indicators such as market breadth measurements and momentum oscillators can provide valuable insights into the underlying strength of the market and help identify any potential warning signs. Additionally, staying informed about economic developments, geopolitical events, and any other factors that could impact the market is crucial for making informed investment decisions. Remember, market cycles are a natural part of investing. Periods of growth are often followed by periods of consolidation or correction. By staying informed, maintaining a disciplined approach, and being prepared for potential volatility, investors can navigate the inevitable ups and downs of the market and protect their long-term financial well-being. While the prospect of a continued bull market is exciting, it is essential to maintain a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. The market's trajectory is influenced by a complex interplay of factors, and attempting to time the market perfectly is often futile. Instead, focus on a sound investment strategy aligned with your goals. Diversify across asset classes, invest in fundamentally sound companies, and remain patient throughout market cycles. Remember, investing is a marathon, not a sprint.